The global financial architecture is experiencing fundamental stress, and recent movements in silver markets have revealed vulnerabilities that can no longer be dismissed. In Western financial centers, silver gets treated as a digital abstraction, a ticker symbol, a chart pattern, a trading position, a speculative vehicle, not as something with genuine material significance, but material significance is precisely what silver possesses. Because silver will be increasingly essential as humanity constructs a world deeply integrated with artificial intelligence, robotics, comprehensive electrification, and sophisticated manufacturing systems. And China recognizes this reality, even as substantial portions of the Western financial establishment continue behaving as though silver represents merely a legacy commodity you acquire during periods of anxiety. Unlike gold, which functions predominantly as a wealth preservation vehicle, silver's valuation is driven substantially by industrial applications. Treating it primarily as a paper instrument only functions in an environment where everything operates smoothly, where globalization flows freely, where liquidity remains abundant, where stability persists, where supply networks prove reliable, where trade follows predictable patterns, and where geopolitical tensions remain manageable. That environment did exist at one point, and it provided tremendous benefits. But it's finished now. And the more rapidly you acknowledge that transformation, the more quickly you can recalibrate your approach. Because silver pricing used to be determined mostly by financial traders. Now it's progressively being established by whoever controls the physical movement of the actual metal, who consumes it, who refines it, who exports it, and who possesses the capability to restrict it. And that's not merely a silver narrative. That represents a paradigm transformation, a return from financial abstraction back toward physical materiality. And it points towards something considerably more significant than silver price fluctuations, which I'm going to clarify. But for the complete picture to make sense, we need to construct the argument methodically, one component at a time. First, you must comprehend that the global order is transforming rapidly. And if you fail to update your strategic framework accordingly, you're going to face severe consequences. When inflation combined with stagnant wage growth forces you to invest actively rather than simply save passively, you must constantly reevaluate macroeconomic conditions. And the fact that so many market participants got caught unprepared by the silver movement tells you something uncomfortable. There exists a massive macroeconomic factor that most investors are completely blind to. The stable international order that permitted investors to think exclusively in terms of financial instruments instead of manufacturing capabilities and practical use cases is beginning to unravel. And that unraveling puts the dollar at genuine risk. That's why commentators have been raising alarms as loudly as possible about America's position and the dollar's status. The uncomfortable question everyone needs to confront, but most people are avoiding, goes like this. As the economic confrontation between the United States and China reaches intensifying levels over the coming years, how stable is the dollar's status as the world's reserve currency? What just transpired with silver provides you a window into that question, because silver represents one of the clearest examples of what happens when a paper market encounters a physical constraint. Now, let's establish the facts as the market is currently interpreting them. As of early 2026, there's been a surge of attention surrounding China tightening control over strategic materials. Reports and market commentary have framed it like this. China implemented a stricter export control regime around silver, requiring government licensing for many shipments, effectively placing more state oversight over a substantial chunk of refined supply and the channels through which it flows. Whether the exact percentage is 60% or 70% or something else, the precise number isn't the critical point. The critical point is that the market is suddenly being forced to think like this. Wait, what if the supply isn't guaranteed? That's the psychological break. That's the pivotal moment. Because silver isn't just some commodity you store in a vault and forget about. It's a critical industrial input. It's in electronics, solar panels, medical equipment, high-efficiency power systems, manufacturing processes, defense applications. It's one of those unusual metals that doesn't feel particularly glamorous, but the modern world quietly depends on it extensively. So when the perception forms that a major node in the supply chain can tighten the spigot, the market doesn't react calmly, it reacts violently. And that's how you get price spikes, volatility surges, and what appears like panic but is actually something deeper, a forced update to the world's mental model. To understand why the silver market is experiencing a state of shock, you have to examine the massive disconnect between what people trade on their screens and what actually exists in physical reality. For decades, we've treated silver as a financial abstraction, a line on a chart, a hedging mechanism, a speculative vehicle, a wager. And that mentality created a level of paper leverage that is almost impossible to comprehend fully. Depending on the venue, the instrument type, and how you're measuring it, estimates of paper claims versus deliverable physical metal can look absurd, sometimes quoted in the hundreds to one ratio. Again, don't get fixated on whether the ratio is 200 to 1 or 300 to 1 or 356 to 1. The fundamental point remains the same. There are far more contractual claims on silver than silver that can actually be delivered at scale on demand. And that is not just interesting trivia, that is a structural vulnerability built into the system. How did this situation develop? Because in a stable, globalized world, most traders don't want the physical metal. They want cash settlement. They want to close the trade. They want the profit or loss recorded. They want liquidity and flexibility. Banks and exchanges realized they could create a tower of paper claims above a foundation of physical metal because everyone assumed the foundation would always be accessible. Ever heard of a bank run? This is the commodity market version of a bank run. Nobody particularly cares what a bank does with their deposited money as long as it's available when they need it. So the bank lends out far more than it physically holds. Fractional reserve banking. Usually it works because not everyone shows up simultaneously demanding their funds. But on the rare occasions when everyone does show up at once, the illusion gets exposed catastrophically. That's the parallel here. For years, paper silver functioned smoothly because the world assumed the underlying physical system was stable, accessible, and inexpensive to move globally. But when a major player tightens supply constraints, when geopolitical reality intrudes forcefully, suddenly the paper market gets stress tested. There's a saying that when the tide goes out, you find out who's been swimming naked. If even a tiny fraction of paper holders suddenly demanded physical delivery for genuine industrial needs, semiconductor manufacturing, solar production, high-end electronics, the entire system would strain tremendously, because there simply isn't enough readily deliverable inventory sitting around to satisfy a sudden shift in behavior patterns. And that's the true reason the price can surge dramatically in a short period of time, not because silver became fundamentally more valuable overnight, but because the market suddenly realizes the structure was built on confidence. Confidence that paper equals physical reality. Confidence that supply is always accessible. Confidence that nobody will call the bluff. But once the bluff is called, the repricing can be absolutely brutal. Now zoom out, because this is where it stops being exclusively a silver story. This takes us back to our central question: the vulnerability of the US dollar. How severe is it? The silver shock reveals a fundamental flaw in the broader American approach. We treat the dollar's reserve status like it's a law of nature, an immutable constant. It isn't. It's a system based on trust, built on confidence. Just like paper silver works only as long as people believe paper claims can become real metal under stress, the dollar system works as long as the world believes that dollars can become real value under pressure. But here's the problem. The dollar is the ultimate paper asset. It's not backed by gold anymore. It's not backed by silver. It's backed by the credibility of the US government, the depth of US financial markets, the reach of US geopolitical power, and the assumption that America remains the safest anchor in any storm. That assumption has been weakening progressively. And when you examine America's debt trajectory, now approaching the high 30 trillions in federal debt, depending on what measure you're using, the question becomes unavoidable. How long can the world keep absorbing paper claims without demanding more real value in return? Because here's the trade the world has been making for decades. America prints pieces of paper and calls them dollars. And in exchange, the rest of the world gives America real things: oil, electronics, manufactured goods, natural resources, labor, and yes, metals like silver. That trade only works as long as the world believes those paper pieces will hold value relative to the real things they're exchanging. When that belief cracks, you don't get a gentle adjustment. You get a regime change. And China has been pushing toward that regime change for years. Not necessarily with one dramatic announcement that flips a switch overnight, but through a slow, systematic building of alternatives. More local currency trade agreements, more bilateral arrangements, more settlement systems operating outside the Western orbit, more stockpiling of real tangible assets, more control of strategic supply chains. And when you combine that with a world that is becoming less stable, more fractured, more militarized economically, the demand for real assets over paper promises rises. It's not ideological, it's not emotional, it's survival logic. Now, silver has another property that makes it an even cleaner mirror of what's happening broadly. Demand is shockingly inelastic in the short term. When silver prices spike, factories don't shut down operations. They don't say, well, I guess we'll stop manufacturing solar panels. They don't say, we'll stop producing medical equipment. They don't say, no more semiconductors this quarter. They pay up. Because for many high value technologies, silver is not a nice to have component. It's a functional requirement for performance. You can sometimes economize on it, use less per unit through engineering. You can sometimes redesign over extended time periods, but you can't just swap it out overnight and maintain the same performance standards without massive engineering changes and lengthy development cycles. That means price doesn't ration demand the way people intuitively expect in standard economics. Shortages don't destroy demand. They transfer pain, usually into corporate profit margins initially, and then eventually into end consumer prices. And that's exactly the kind of setup that breaks paper markets when physical supply constraints get tight. Now, here's where it gets even more dangerous from a supply perspective. Most people assume if prices rise sufficiently, miners will produce more. That's a nice, clean textbook assumption from Economics 101. But silver doesn't work like that in practice. A large chunk of global silver production emerges as a byproduct, extracted incidentally while mining other metals like copper, lead, zinc, and gold. So silver supply doesn't respond neatly and predictably to silver prices alone. If copper demand is weak globally, copper miners don't ramp up operations just because silver is expensive. If a big zinc project gets delayed for regulatory or technical reasons, silver supply stalls right along with it. The supply response is messy, slow, and structurally constrained in ways that don't fit simple models. Now, take that exact logic and overlay it on top of US debt dynamics. Even if the global appetite for US debt weakens, if foreign buyers start stepping back progressively, America doesn't get to say, okay, we'll stop making interest payments. Those payments are inelastic, they keep coming regardless. And when debt reaches enormous levels, servicing it becomes the gravitational center of policy decisions, which creates pressure for monetary expansion, for financial repression strategies, for policy choices that devalue the currency gradually, because the alternative is immediate severe pain. And that's why the silver story matters so profoundly. It's a case study in what happens when people realize paper promises are not equivalent to physical reality. The common fantasy goes like this. We print the world's reserve currency, so we have an infinite get-out-of-jail-free card. And yes, printing money can bridge gaps in the short term, can postpone crises temporarily, but it also accelerates the long-term loss of trust and confidence. This is the confidence spiral mechanism. Print money to cover the immediate problem. The world notices and registers the action. The world demands a higher premium to hold your paper going forward. Interest rates rise, debt service costs rise. You print more to cover those costs, confidence weakens more participants flee, and eventually the system transitions, not overnight, but decisively, from trusted anchor to paper risk. Now, if you think I'm overstating this dynamic, consider what China and other major players have been doing strategically, building alternative infrastructure rails, alternative settlement mechanisms, alternative trade lanes, systems specifically designed to keep commerce moving even if Western financial pipes are restricted or weaponized. And the more those alternative systems mature and gain functionality, the less mandatory the dollar becomes for international commerce. This doesn't mean the dollar disappears tomorrow morning. Reserve status erodes the way cliffs erode, quietly and gradually, then suddenly and catastrophically. And that's what analysts have been warning about for years. When debt becomes fundamentally unsustainable and rival powers offer viable alternatives, countries don't announce a formal divorce. They just start living separate lives, systematically and permanently. So how do you navigate a world where paper abstractions melt and physical reality takes control again? You need an anti-fragile strategy, one with no single point of failure, because most people today are fragile in their positioning. Their entire net worth is tied to the continued stability of the dollar and the continued stability of paper markets. And in a world where the global order is shifting fundamentally, that's a massive vulnerability. America is in trouble, and the dollar system is under genuine strain. Consider the lessons from major investors who've navigated previous regime changes. Massive cash positions aren't just about safety during a crisis. Cash represents optionality. It allows you to be greedy when others are fearful. It allows you to react instead of predict. And prediction is what breaks people financially. Because in a regime shift, the old models fail completely. When the world order is stable, you can get away with lazy assumptions and simple heuristics. When the world order is unstable, lazy assumptions become bankruptcy. Study of the last 500 years of empires rising and falling reveals patterns around debt cycles, internal conflict, and external rivalry. The argument has always been that when you combine high debt levels, internal division, and a rising peer competitor, you enter the danger zone. Not because collapse is guaranteed tomorrow, but because the probability distribution shifts dramatically. Tail risks get fatter. Extreme outcomes become more likely. And the framework for dealing with that isn't doom and paralysis. It's balance, building portfolios that can survive multiple climates, growth, recession, inflation, deflation, geopolitical stress, without needing one perfect forecast. If you put this together and take a first principles approach that blends what silver is teaching us with what major investment frameworks are implying, the path forward looks something like this. Step 1. Accept that the post-World War II paper era is dying rapidly. Stop thinking in terms of frictionless globalization. Start thinking in terms of great power politics. Supply chains become strategic assets. Resources become leverage points. Technology becomes a battlefield. Finance stops being purely about valuation multiples and starts being about access and control. Step 2. Don't pull out of markets in panic, but recognize you can't save your way to prosperity anymore. In a world of fiscal dominance where debt pressures drive monetary policy, cash in a standard savings account is not a safe haven. It's a melting ice cube. You need enough cash to survive immediate volatility, call it 6 to 12 months of expenses, to stay emotionally stable. But beyond that, holding too much cash can become exposure to a system specifically designed to devalue purchasing power over time. Step 3. Shift from pure financial instruments toward productive assets with pricing power. Own things that have genuine pricing power. Own businesses that can raise prices when costs rise. Own assets tied to real demand that persists. Own resources that are functional requirements for the economy. Because in a physical world, factories don't stop production because silver hits $100 per ounce. They pay the premium and pass costs forward. Owning functional requirements of the future economy is one of the best ways to ensure your wealth moves with or ahead of the rate of monetary expansion. Step 4. Diversify across economic forces, not just asset classes. True diversification isn't owning 10 technology stocks. That's 10 versions of the same fundamental bet. Diversification is owning assets that behave differently under various stress conditions. When the dollar is under attack, you want exposure to assets that aren't someone else's liability. Hard assets, commodities, certain global equities, real cash flowing businesses, things that can breathe when credit markets suffocate. Step 5. Don't try to predict the future with precision. Preserve optionality instead. Be invested, yes, because inflation makes sitting out costly. But watch liquidity carefully, duration risk and counterparty risk. The future is guaranteed to surprise you, both pleasantly and unpleasantly. Your goal isn't to win one perfect trade. Your goal is to survive the disorder long enough to capitalize when genuine opportunity shows up. Because that's what happens in every regime change throughout history. There is always chaos, and there is always opportunity emerging from that chaos. China has updated its mental model of how the world works. Major investors have updated theirs. If you're still clinging to the paper era rules like they're permanent laws of physics, you're making yourself the most fragile participant in the room. So take this silver move seriously, not as merely a metal story, but as a warning flare that physical reality is reasserting itself over financial abstraction. The global financial architecture that permitted decades of paper leverage is encountering the hard constraints of physical reality. Silver is just one example, one relatively small market that revealed the vulnerability. But the principle applies far more broadly. Every paper market contains embedded assumptions about the stability of the underlying physical system. Every currency contains embedded assumptions about the credibility and sustainability of the issuing government. Every financial instrument contains embedded assumptions about the continuation of the current regime. When those assumptions get tested simultaneously, when multiple systems experience stress at once, the correlations that investors assumed would remain stable break down completely. Assets that were supposed to diversify suddenly move together. Hedges that were supposed to protect suddenly fail. Liquidity that was supposed to be available suddenly disappears. That's the nature of regime change. It doesn't announce itself politely and give you time to adjust. It arrives suddenly, even though the underlying stresses built gradually over years. The silver market's recent behavior represents a microcosm of this broader dynamic. For years, decades really, the system functioned smoothly. Paper claims circulated freely. Physical metal moved when needed. Prices fluctuated within ranges. Everyone understood the rules. Then suddenly, the rules changed, or more accurately, reality reasserted itself and revealed that the rules were never as solid as people assumed. The paper structure was always built on confidence, and confidence can evaporate rapidly when circumstances change. This is the core lesson that extends far beyond silver to the dollar itself, to the entire Western financial system. The architecture we've built over the past several decades assumes a level of stability, cooperation, and trust that may no longer exist. We've assumed that global supply chains will remain open and reliable. We've assumed that geopolitical tensions will remain manageable and won't seriously disrupt commerce. We've assumed that the dollar's reserve status is permanent and unassailable. We've assumed that paper claims will always be convertible to real value when needed. But what happens when those assumptions break? What happens when a major power decides that maintaining the current system no longer serves its interests? What happens when strategic resources become tools of leverage rather than commodities traded freely? What happens when the world fragments into competing economic blocks with different currencies, different standards, different systems? The comfortable assumptions that permitted paper abstraction to dominate start looking very fragile indeed. The response to these challenges requires fundamental rethinking, not just tactical adjustments. It's not enough to shift a few percentage points between asset classes or adjust your equity exposure slightly. The entire framework needs updating. Your mental model of how the world works needs updating. Your understanding of what constitutes safety needs updating. Your approach to building and preserving wealth needs updating. Physical assets with real utility become more valuable in this environment. Businesses with genuine pricing power become more valuable. Companies that control critical supply chains become more valuable. Resources that are functional requirements for advanced economies become more valuable. All of these represent claims on real production, real capability, real value, not just paper promises. At the same time, excessive concentration in any single currency, any single market, any single system becomes more dangerous. The world is fragmenting, and that fragmentation creates both risks and opportunities. The risk is that your wealth gets trapped in a system that's devaluing or losing global relevance. The opportunity is that new systems emerging create new ways to preserve and grow wealth. This isn't about predicting exactly when or how the current system transforms. It's about recognizing that transformation is underway and positioning accordingly. It's about building resilience into your financial structure so that you can survive and thrive regardless of which specific scenario unfolds. It's about maintaining optionality so that when clarity emerges, you have the resources and flexibility to act decisively. The investors and thinkers who successfully navigate regime changes throughout history share certain characteristics. They maintain healthy skepticism toward prevailing orthodoxy. They watch what major powers do, not just what they say. They understand that systems that seem permanent can change surprisingly quickly. They build positions that can survive multiple scenarios rather than betting everything on one forecast. They keep enough liquidity to act when opportunities appear. They avoid excessive leverage that could force liquidation at the worst possible moment. Most importantly, they update their mental models continuously as new information emerges. They don't cling to old frameworks that no longer match reality. They don't assume that because something worked for decades, it will necessarily work going forward. They recognize inflection points and regime changes and adapt accordingly. The silver situation represents one such inflection point, one clear signal that the old regime is straining. It won't be the last signal. There will be others across different markets, different asset classes, different systems. Each one will provide additional information about how the transition is unfolding. Each one will create both danger for the unprepared and opportunity for those positioned correctly. The question isn't whether the world is changing. The world is clearly changing. The question is whether you're changing with it, whether you're updating your strategy to match new realities, whether you're building the kind of resilient, diversified, physically grounded portfolio that can survive and thrive in a world where paper abstractions give way to physical constraints. This transition will create winners and losers. Those who recognize what's happening and position accordingly will preserve and likely grow their wealth substantially. Those who cling to old assumptions and old strategies will watch their wealth erode as the system they depended on transforms beneath them. The choice, as always, is yours. But the evidence of change is mounting, and the silver market just provided one more very clear signal that the transition is accelerating.